Welcome to Geared for Growth. I'm your host, Mike Mortlock, Managing Director of MCG Quantity Surveyors. Today, we're speaking to an old podcast guest, Jong, who's the founder of Game Plans. Now, Game Plans is a platform that helps property investors reverse engineer their portfolio to achieve what they've set out to achieve financially. And we have a chat to him about some of the secrets about how people are generating these 30, 40, 60, 100 property portfolios and what he sees as the common threads that denote property investment success, the people that actually achieve in excess of the average one investment property. It's an awesome interview with Jordan, and I'm sure you're going to get something out of it. Here's Jordan. Jordandejong, thanks for joining me back on Geared for Growth.
Mate, it is a pleasure. It's been a little while since I've been on, but I think you were my first public podcast that I ever attended, so it's good to be back.
Is that right?
I think so.
So the first podcast you ever did was Geared for Growth?
I think so, yeah, definitely.
Because, we have known each other for quite some time. I mean, you were living in Melbourne back then, and I'm guessing that would have been maybe 2017 or 18 or something like that.
It was definitely pre-COVID, yeah. It would have been 17, 18 when I started the original podcast. Yeah, so, man, it's been a while.
Yeah, and you were working within a construction firm, running their sort of analytics and their project. And we were talking about, we got you on to sort of say like, well, what is AI and how does that work for property? Which sounds a little bit weird, but since then, obviously, you've gone on to create a huge business for yourself, a huge profile in the property space. And I'd love to unpack some of your learnings as well. And for people that don't or aren't up to date on what you're actually doing, so that'll maybe give us a good framework to why I'm asking these questions. Can you give us a bit of an insight into Game Plans?
Yeah, 100%. So we're an online property portfolio management system. And essentially what we do is we sit down and we understand, okay, well, what do you actually want out of your property portfolio? So the biggest thing for me, going back to when I was on the corporate ladder, is I had built this, 3 property portfolio, and I was listening to all the podcasts like this one. I was reading all the books, and, there was these people that had 10 properties in their portfolio, 20 properties in their portfolio. And after I got to my third, I got stuck. Like Mr. Banker said, well, you can't borrow anymore. You're at your borrowing capacity limit. And from all these things I was learning and reading, I didn't know that was a thing. Like I just thought I could buy infinite properties in trusts and recycle debt and do all these, really cool strategies that had been implemented 10 or 20 years prior because, with the lag of information, this is what you learn. And so for me, I went through this really hard time of like, well, I can't really physically see how I'm going to be able to retire through property now. I need to start to map this out. So like any mathematically minded investor, I created my own gigantic spreadsheet that had 1,001 formulas that would always break, and built out this kind of plan of like, well, how am I going to be able to do this? Am I actually going to be able to retire through property? And through that process, I realized that, well, there's actually a lot of value in doing this and kind of viewing that out and mapping that out. And that's when I decided to change the Excel spreadsheet that I had into a software piece. And that's essentially what Game Plans does is we analyze your current position, look at your current portfolio, see where you're at, where you can improve, where things might be not working as well. We could update, see what the yields are, all those sort of good numbers and metrics that we all like to monitor. But then we also add in the forecasting side of things. So we go, well, what is your long-term goals? What do you actually want out of property? What's your time horizon? What's your risk profile? So you do want to, like, there's plenty of people in the industry that are quote unquote go balls to the walls. I don't know if I can say that, but they go really aggressive. And then there's other people who are a little bit more conservative and they might not, they want to have bigger buffers and all that sort of stuff. So we try and understand that from a unique individual's point of view or couple's point of view as well, which can sometimes get complex because couples want different things. But just understanding kind of where you are, where you want to go, and then we try and fill that gap. So we go, okay, well, based on your current savings, your current income, how much you can save per month, how much borrowing capacity or borrowable equity that you've got, we might need to do another purchase in 2 years' time because we don't have the cash available now, or we don't have the borrowable equity now. We're in a tougher economy. Maybe when interest rates come down, we might have a little bit more accessibility to cash or to borrow cash, so we can go and buy another one. But if we're just given the 3 properties that we've got now, we're not going to be able to hit our goal. We are going to need to buy 2 or 3 more assets over the next 5 to 7 years to be able to then have enough time in between paying down some debt to be able to get into that longer term position of maybe, let's say, a goal of 100K passive income or 150K passive income. But the best thing that we do is take all the future numbers. So we start to inflation adjust all our numbers over that 30-year time horizon. And so if someone says they want 100 grand now, well, it's really not 100 grand in 30 years. It's closer to 200 grand, 250 grand. And so we try and adjust for all of that, really look ahead and go, well, this is where we are. This is where we want to be, but in 15 years' time. So this is the goal number now. How do we build that and get our way to get there over that longer term period?
Thanks for that rundown too, by the way. It's fantastic. Anyone that has listened to this podcast before is probably sick of me sort of saying things like, you can have your dessert, but you got to eat your veggies first. And the dessert is, should I buy in Perth or Toowoomba or Townsville? But the veggies is, well, what are you actually trying to achieve? And that's where I see a huge gap and a huge problem for property investors. They just go, oh, this place is going to boom. And they're collecting property because they sort of know intuitively that that's probably a good thing to do. But unless you know exactly where you're trying to get, you're not likely to be making the absolute perfect steps in that direction. And that's, I think, the problem that you solve, and you've been incredibly successful about that. But I want to ask the question because the sort of the genus of your business really began with you taking a number of what I suppose buyers agents would call discovery calls. And you actually sort of did that as like a contractor to a number of buyers agents. And I'm guessing you took hundreds and hundreds and hundreds of calls. So I want to know, did you see people taking that approach? Like, I want X, so I've got to reverse engineer it? Or it's just like, I want to get an investment property because that seems like a good idea?
Yeah, there's a couple of things that were quite common. So there used to be a way, and I was talking about this before, where you could buy essentially a property under a separate trust, set up a new trust every single time, get new lending underneath that trust, and then, set up trust number 2, trust number 3, trust number 4, but not disclose those other trusts to various banks. And you essentially get different loans, through different banks. And so a lot of people, especially through the Steve McKnight books, which is what got me into property, kind of learned that method. And so I thought that was the way to do it. Lo and behold, policy changes. We're in a world of open banking. Everyone can see everything now. So it's not as simple to do it that way. The second thing that we commonly see in the story that's out there is, okay, well, what you got to do is buy 10 properties, hold them for 10 years, sell 5 of them, pay the debt off the rest of them. And that strategy used to work quite well as well. But we're in a scenario these days where you can't actually get the borrowing capacity to buy 10 properties. It's just not available. So we have to stretch and understand what we can buy with our borrowing capacity, which for most people listening is a rough 6 times income rule. So if we take the Australian household income of 180 grand, most people can borrow up to around 1.2, 1.3 million in their entire portfolio. So some people might buy a big family home and then all of a sudden that borrowing capacity is chewed up. Some people might, like me, go out and buy 3 investment properties around the 500K range. And again, their borrowing capacity is chewed up. So this is where most people get stuck. The other scenario that we see out there that a lot of people get confused about, and this is the biggest one for me, is we see these property experts that are out there, and by all means they are experts. They've done really well. They've built a big portfolio, but they've got portfolios of 10, 20, 30, 40 properties. And I always got asked the question, like, how are you able to build a portfolio that big? And a big secret that not a lot of people talk about is, well, a lot of these people have actually established quite large businesses that help them underpin that bigger portfolio that can help them scale and build. Yes, they may have started in property and investing and getting in there nice and early, and it would have helped them get the confidence or maybe have the financial backing to be able to step out and start the business and continue on their journey. But the reason they have grown such large portfolios is because they've also built a business on the back of it, which has helped them to continue to invest down the track. So a combination of those 3 sort of questions is what we commonly quite see. And the best way that I sort of answer this is most people can actually achieve their goals within 3 to 5 properties, depending on what they buy. So with that whole philosophy of, well, I need to buy 10 properties, you can answer the same thing as well. You could have 10 properties worth 200K or 1 property worth $2 million. Same asset value, portfolio value. But for me, I'd much rather have 1 tenant, 1 aircon to fix, 1 kitchen to fix, 1 thing to renovate, and not have 10 of these things, 10 headaches, 10 stresses at night. Other people are very different. Maybe they like that lower quality asset. Maybe they can, manufacture a whole lot more equity out of those individual smaller assets. They can go from 200 to 350K really quickly, not as easy as to go from 2 million to 3.5 million, and build that asset base really quickly and help them continue to build the portfolio out from there. So again, it really comes down to that risk profile. If you do want to be that more aggressive and active investor, there's definitely ways out there that you can manufacture equity, recycle that, continue to go again. If you want to be a more sort of passive investor, there's the bigger assets, the sort of quote unquote blue chip assets that we can get into to sit and hold and just let time do its thing. But we do have or go through kind of different stages within the portfolio. Firstly, we want to get into sort of the growth type assets. And the reason for that is we want to build that equity base. Majority of the time, property is increasing at a greater rate that we could save. And so by getting into a growth type asset first, we're leveraging into that asset, then we're allowing the market and time to do its thing. That's going to generate some borrowable equity for us over the course of the next, market cycle. So it could be 5 to 7 years. And then we extract that equity and we use it as a deposit for purchase number 2, because it's going to be impossible to save, again, another massive deposit for purchase number 2. With purchase number 2, it could be a multitude of different things, depending on the time horizon. So if we're working with someone who's got 10 or 15 years, maybe we do start to move to something a little bit more higher cash flow to help offset the negative gearing of the growth type asset and start to build that way to the passive income stream. Alternatively, if we've got someone who wants a generational play, or maybe they've got 30 years, or maybe they just want to be as wealthy as possible, we can continue down that blue chip route to continue build that wealth base and accumulate and let time do its thing. But at some point in the portfolio, we generally see most people move to these higher yielding type assets. And it generally comes in the form of something like a commercial property. And the reason we see this at the end of the portfolio is because generally they've maxed out their borrowing capacity in the early days. Yep. So they've borrowed that 1.4 million. If they've got a business, maybe they've borrowed 3 million and the bank says you can't borrow anymore. And when we do move to commercial, we can get different types of loans, something called a lease stock loan, which is essentially just a loan on the asset based on the rental income or the yield of the property. So the bank will assess the asset individually and say, well, look, you've got a 5 by 5 by 5 year lease on this. It's a really solid tenant. They've been there for 15 years. There's more income coming in. There's expenses going out, plus the tenant's paying for all the outgoings. So we're happy to give you a loan at a 70% LVR, and we're not going to take your personal financial circumstances into consideration. And so we can then continue to build the portfolio with, not a different type of asset, but a different class of property asset to help continue grow and build the portfolio over time. Now, there's an argument to get into a commercial property first if your goal is just to retire as soon as possible and build up a passive income stream. However, the reason we don't want to do that first generally is because you want to utilize what you can borrow with the big 4 major banks as quickly as you can. Well, not as quickly, but before you start to move into these other types of loan where it's harder to reverse engineer. So say you went commercial first with the lease stock loan, and then you wanted to get into residential. Well, it's not the same metric. They'll assess the commercial loan and go, well, your liabilities overall are 3 million, so you can't borrow as much as possible. So generally we see sort of 3 to 5 properties, growth, then what we classify as momentum, which is that combination of growth plus cash flow, and then we move into high cash flow assets at the end.
I love that rundown, and especially the sort of the transitioning from strategies depending on your time horizon and where you're going to get to. One thing I was really excited that I saw you produce, probably goes back a couple of years ago now, is that you have a tremendous amount of data within the platform now. So you can see the average person in the platform has X amount of properties or X amount of equity or a certain specific LVR. What has the macro taught you about the state of the average property investor that you see, which is, there's an argument to say, typically are a little bit more sophisticated than average because they're often working with a buyer's agent, which is kind of like the lead into what you do rather than being direct to consumer. The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Yeah, 100%. I think, the whole reason we kind of produced that data and, have that content around being open with everyone is there's this statistic that's out there that, only 0.5%, I don't know the actual number, but it's something like 0.5% of worth of property investors own 6 or more properties. And unfortunately, it's one of those things that people who do have 6 or more properties claim to be, this expert property investor or like the highest tier of property. And I'm sure they've done really well. The sad thing about it is the same scenario before. I was like, sure, you could have 6 properties worth 200K, but that's only a $1.2 million portfolio where, generally most people are able to buy a $1.2 million property as their family home, and it's the same asset value. And so what we try and break down is not just look at, the number of properties, which in reality doesn't have any sort of comparable metrics in terms of what we're doing. It's just a quantity, and understand the size of a portfolio overall. So what's the average size of a portfolio? And I'd say most, investors who are kind of happy with where their portfolio at probably sit at around $2 to $3 million after they finish that acquisition phase of their portfolio. So for the people that are out there that might have 1 or 2 properties and are feeling like, oh, how's this guy got 6, or how's this guy got 20, I wouldn't feel too bad about it. It all comes down to the quality of the asset, depending on the type of investor that you are. And if you've got really good quality properties in your portfolio and they've performed well for you, don't feel like you're falling behind or you're not, you need to get that 6 because it's just a number or statistic that's out there. So it's all just about opening it up to everyone and understanding what property investing looks like holistically, rather than just keeping it to a number that I'm sure is just like a census data thing that they grab and everyone, for whatever reason, creates content around it.
Yeah. And I think the people that have 3 are looking at the people that have 6 going, oh, I'm such a failure. Look at them. And then the people that have 6 are looking at people with 20 going, gosh, I wish I could do that. Like I've hardly even got started. And then the people with 20 are looking at people with 100 million going like, oh gosh, like that's proper wealth. And, there's always someone better, I suppose, is my point. Now, getting back to the little snippet that you shared before, which was, there's not a lot of people that understand that many of these, especially buyer's agents, right, that have 20, 30, 50, 100 properties, many of them may have got to a certain point where it was, they were hitting their head against that finance game. And not to say that everyone can make millions of dollars as a buyer's agent, but there are some that have come with a relatively modest portfolio, built mega businesses that typically run at a very high net profit margin, and suddenly, they can 10x the size of their portfolio. Yet people like you and I are looking at them and seeing what they're doing and sort of wondering like, well, I guess I'm just doing it wrong, or I don't kind of understand, or I need to work with them, obviously, because that's the secret sauce. For your average person that doesn't have the ability to look at a big cash flow business, do you often see people getting to those 10 and 20 portfolio properties just by running that finance game?
Yeah, I mean, if you do the finance game properly, and you really need to work with 2 really savvy people. First is an accountant who can help you structure things properly, get everything set up properly, have the right, cash flow identities and tax returns and everything set up really correctly, alongside an investment savvy mortgage broker. Again, help you structure the finance things correctly. I have been able to see it. I wouldn't say it comes down to luck. But I would say that they'd have to be quite lucky to get a lot of things right. As a property investor myself, I've made plenty of mistakes, and I speak to property investors every day, and almost everyone makes mistakes. But I definitely have seen people with portfolios with first property got, doubled essentially in 2 years. The second one tripled in 4 years. The third one's, gone up by half in another year. And that, they've just done really well in terms of timing the market and what they've gotten into. And that's allowed them to then extract that equity and move into the next asset and continue moving the thing forward. And typically they understand holistically how the lending landscape works. Maybe they have been in a season where they had a higher income, or they had maybe they've got a role that's a sales role and they've had a really high commission year, and they were smart about it. They utilized the borrowing capacity or the tax return of that particular year. They've been able to borrow a whole lot more. They understood that, well, we're going to need a cash flow to underpin this portfolio because I'm not always going to have the income. But we've been able to establish and build a portfolio of that specific time frame to bring in the side from there. But for individuals who, if we're just got the yearly salary and we're stuck at a certain borrowing capacity level, I always say that each individual property in your portfolio should have a specific reason. If you are just looking for growth, then we want growth focused assets. If we're just looking for cash flow and to retire as soon as possible, there may come a point within the portfolio where we need to reestablish. We might need to go, okay, well, this growth asset has done its thing over the last 15 years. We're really happy with the returns. I'm never a fan of selling an asset. But if the goal is, well, we just want to retire in the next year or two, we could potentially look at offloading that asset, using the equity and getting into those high income type assets, which then will allow us to go back to where we're at. And the biggest thing of this is, again, talking about Steve McKnight, I think at one point he had 250 properties or something like that. And he's got his own story with his business partner and everything else like that. But last I heard, all he has now is 3 commercial assets. He's not after the 200, 300, 400 properties. He's not that, super hungry. And I'm sure he's hungry, but he's not like wanting more and more and more. He's just really simplified it, brought it back down. Now he's got 3 assets plus his family home, and he's quite comfortable with that. So, even from someone who is at that really, really, or had been at that really, really extreme level, he's really just simplified his portfolio and brought it back down. And I think everyone does go through their phases of their portfolio where we need to just rebase, reestablish what we want. And sometimes, if we've got 10 tenants and 10 things to fix and 10 issues and tax returns, it's just easier to turn that back down to 1 or 2 and have some solid assets, some quality assets in the portfolio.
I love that. And I suppose with your platform, people will jump on board, they'll enter in, the salary, the property that they own. And I guess you have the opportunity to see the progression of portfolios over time. And is that kind of as what you've come to the idea that people typically will start with growth and then they can kind of leverage that equity into different things. And then as they approach a retirement age, you see the cash flow stuff starting to come in, or it's maybe servicing that negative gear position, and then they go full on cash flow and perhaps even dispose of some assets. Is it you witnessing what happens within your ecosystem, or is it more about the conversations you've had with successful investors?
Yeah, I think the biggest thing is definitely the cash flow aspect, because not a lot of people think about that. So I think, we all get not rammed down our throats, but we're taught that, property in itself is a growth type vehicle, right? There's plenty of other assets out there that are much better for cash flow. And so when we look at investing, and the reason they're growth is because we can leverage into them. We can leverage that 80%, that 90% position. We can use someone else's money to help leverage our financial position and gather that growth. So from very early on, we're taught, well, property is a growth type vehicle. Let's get into growth type assets. But what we tend to see, particularly in today's economy, where we're at sort of 6.5% interest rates, is let's say you buy $1 million asset and you've got an $800K loan on that. It could be costing you 30, 40, 50 grand a year in terms of repayments. And for the average household, that's a lot of money. That's a lot of money coming out of our back pocket, especially if it's the family home, because it's after tax money. But even if it is an investment and pre-tax, it's still a lot. And so not everyone can afford to have 2 or 3 or 4 of these things in the portfolio, because we can't afford 100 grand, 150 grand worth of, property repayments every single year. It's going to cost a fortune. And so we definitely see that transition of, well, we've got one, what they call, big rock in the jar. We've got our solid growth type asset. And look, that might be hemorrhaging 20 or 30 grand a year. But it's unsustainable to continue buying big rocks. We need to have these little ones that are surrounding it that are helping to underpin that cash flow position, stabilize that cash flow position. And then, we might head into an interest rate environment that's a little bit less today. Everyone feels really comfortable. Then they go out and be super aggressive again and forget how hard it was. And this is definitely what we saw during COVID, was there was a lot of people who just went, well, money's essentially free. I'm just going to go out and buy, 2 or 3 of these things. And then they got unstuck when interest rates have come up. And so this is what we do with the future forecasting, is just going understand, well, we actually have a chart which is plus 2% interest rates, minus 2% interest rates. So we can utilize that 6.5% rate today, but we can say, well, what happens if interest rates go up by 2%? And what happens if interest rates come down by 2%? And what I always say to clients is, you want to make sure you're comfortable in both those positions. I'm sure you're going to be comfortable in the minus 2%, but what we need to do is be able to sleep at night if we're paying, if we're saying we're paying 50 grand a year now, but at +2, we're at 70 grand a year. And all of a sudden now we can't afford to hold on to the portfolio. Well, that's a financial decision where you're paying stamp duty, building and pest expenses, conveyancing expenses. We say it's 6% on the way in with all those costs and 3% on the way out. So agent selling fees and everything else like that. So you actually need the property to grow by a minimum of 10% to even make your money back. And so, this is one thing that not a lot of people take in consideration is, yeah, it's great you get in and maybe you've had, let's say it's grown 15 or 20% in the time you've had it, but now all of a sudden you're forced to do a fire sale because it's too expensive to hold on to. Well, you've just given yourself a headache for a year and a half and you haven't really gained any wealth from it anyway. So, it's just one thing to consider, and that's not even factoring in like capital gains tax, everything else like that as well. It's just one thing to consider when we're planning out is, well, what is the best case, worst case scenario? Are we going to be able to survive in the worst case scenario? And if so, let's make the decision and make the call on it, because otherwise we're not going to be able to transition at some point in time. But back to your question, definitely yes. As we start to head into the later years, we see two common things. The first one is someone who has had a life where they've had it tough and they might have kids, and they don't want their kids to ever be in a financial situation that they were in when they grew up. So they will sacrifice. They might work until they're 60, 70, 80 years old, build up quite a large portfolio, and then have something as a legacy play to hand over to the next generation. Or number two is, we generally see people who get to roughly sort of 50, 55 and go, well, the line's coming up sometime soon. We need to plan for this retirement play. And they might start to either continue to move into the higher cash flow assets or actually transition out of their wealth base. Maybe and this is probably a really good thing to consider if we are in that cohort, wait until a really good market cycle comes up. No one's going to be able to pick the bottom or the top, but if we're in a really good market cycle where things are really good, there's 30, 40 people at each auction, maybe it is time to offload a particular asset and reinvest those funds back into that high cash flow asset to help underpin and support that retirement goal. Depends what you want out of property. Some people are happy to just have their wealth play, sell out everything and have this big lump sum of cash, but it's the same as like selling a business. Like the biggest common thing that I hear from people that sell businesses is it's great. They get this lump sum of cash in the bank, but now all of a sudden they've got no money coming in. And so it's kind of like, well, now we're just hemorrhaging from our big lump of sum of savings. With inflation, it's not going to last too long. So we just want to make sure that whatever we're doing, we've got enough in the kitty or we've got some cash coming in to help us through those high cost periods at the later stage of life.
You mentioned surviving, and I think, of course, that's an important thing. We need to make sure that we can sustain the mortgage payments so we can live without putting ourselves into duress. But I always sort of go back to that stat that 71% of people only own one investment property. And I think, you've mentioned it today, and there's enough data to suggest that that's not really enough. And when you said, depends what you want out of property. Well, I think what people want is to fundamentally change their financial futures, right? Because people don't just want to buy an investment property so they can drive past with a mate and go, I own that, and feel really special. They actually want their lives to sort of change. Yet there's a fairly strong argument to say that 71% of investors, which is a big chunk, are not actually achieving that. I think in some respects, if they don't survive, they have to sell it, and that is a huge loss. Like, as you say, you need 10% just to cover your in and outs, and sometimes these properties will actually decrease in value. I'm just wondering, what is it that people are missing? Why are investors, according to that stat, so unsuccessful from what you've seen from so many successful investors?
Yeah, I think that the biggest thing is, firstly, not that this is a bad thing or a bad move to make, but they will get into their family home, which is where they want to live, and that will chew up most of their borrowing capacity. And that, let's say in that scenario where someone can borrow 1.4 million, let's say that they've got a debt of 900K on their home, and then they've talked to their uncle at the barbecue and they've gotten into an investment property. Maybe they're not as into the people that are listening to this podcast, where you're in property, you're listening to property, you're consuming all the content that's out there, but they've just heard that property is a good thing. And so then they go out and go, well, I need to now get an investment property. If we run the maths, 1.4 minus 900K gives us 500K borrowing capacity. Really, you're probably not going to get a two good properties out of that. You probably just want one solid one. So you might buy something for, let's say, 650K. And then all of a sudden we've got another 500K debt. That takes us to our 1.5 million cap. And then they go, okay, well, I've got my home, got my investment. I'll go talk to Mr. Banker for some more funding. And he says no. So then they just decide, well, I've been told no, can't continue investing. I'm just going to stick to my one investment property. That's probably 60% of the scenarios that we see of why people get stuck on that one property. It's really the people that are hungry to learn about property investing and hungry to continue investing that allows them to get to 2 to 3 to 4, because they're the ones who are learning these things like lease stock loans. They're the ones that are learning things like borrowing capacity. They're the ones who are watching the economy and taking advantage of different market cycles when lending might be a little bit cheaper to help continue build the portfolio. They're the ones that are considering, well, what's the yield and the income and the expenses of the assets, so the banks might be able to assess it a little bit differently. They're the ones that are learning about the second or third tier lenders that might be able to give us some, different forms of lending at a higher interest rate, but continue to investing from there. So I think, that stat of 71% of investors is just people who have heard property investing is good. They've seen what it's done for other people, maybe in their family or their friendship group, and decided, well, I want to now be a property investor. But they're generally capped and not as interested to continue building out that investment portfolio.
And would you say what differentiates those from the successful investor is part of what your platform does? It's like, well, let's think about what we actually want to achieve. What do we want our life to look like? What do we want our income to be when we stop work? And then we actually go, all right, well, it is a game of finance. We have a certain amount of time frame. Let's say that's the rules of the game. Is like, you've got this salary, this capacity, this amount of time. And then they actually strategically go, these are the moves on the chessboard we need to make?
Yeah, 100%. I'm not going to spike the platform anymore, but essentially that is the outcome, right? Is they kind of understand and maybe they're not numbers people, and they kind of have this buy and pray type strategy. Okay, I've got my home, got the investment property, hopefully it does well over the next 30 years. And by all means, that's fine. They might not be math guys. They might not be people who want to understand what's actually going to happen in a couple of years' time. And, good on them for getting into an investment property. I'm sure they're going to do well out of that one thing, but they haven't really broken it down and had a look and going, well, this is like, I do want 100K worth of passive income to potentially retire on and travel and do all my things and replace my income at some point in time. Am I going to be able to do that with one property? And majority of the time, the answer to that question is no. And so it's all about just, sitting down, looking out that 15-year time horizon, going, okay, well, we're actually going to need 170 grand. This one property is only going to get us to 50 grand. So where are we going to make that difference of 120K? And what are the moves that we need to make on the chessboard to be able to get that in that time horizon?
Yeah. And I think what we have in common is that we actually love seeing people win, right? And these are the things that I think engage us to do podcasts like this, because you actually get energized by the success of other people. And at the end of the day, no one cares more about you and your success than you do. So would you say, you would compel people to go, all right, well, if you are serious about it and you want to achieve something, you actually do have to learn this, or you have to put in a bit of work, or at the very least find the right advisors who've perhaps done what you want to do, and then get them to help you to do it? What would be your advice to someone that's like, I've listened to this podcast and I'm on board, I need this to happen, but I'm actually not sure what to do first?
Yeah, I think the biggest thing, and I got caught up with this in the early days. If you're listening to this podcast and you're also listening to 5 other property podcasts, and one guy's saying, yeah, you got to buy 10 and sell half. One guy's saying, yeah, you got to buy 3 and renovate. Another person saying, just go commercial. Another person saying, do X, Y, and Z strategy. There's 101 people out there. And look, by all means, I think all of their strategies individually have probably worked for them or their clients at some point in time. But I would say read or listen to someone that you really resonate with, someone that you align with. And if you say are an active investor and you want to go out and buy lower quality properties, but lower value properties to then manufacture equity, renovate, get in, and be that like really aggressive active investor, go listen to someone who does that strategy and work alongside them, because that's who you're going to most align with. That's who you're going to be comfortable with. That's how you're going to want to learn how to property invest and do it that way. If you're someone like myself who, I would say I'm lazy and procrastinate. I just want to buy the thing and just let time do its thing. Like I don't want to be an active investor. I don't like forking out the money for a renovation when I'm not guaranteed what a return's going to be or anything else like that. I'm sure there's going to be a return if you run the numbers, but I'd rather not do it all at all, completely together. So listen to someone who you really align with, understand what their strategy is, look at how they've been able to build their portfolio and go, okay, I think this is the path that I want to go down. I would recommend speaking to at least 5 different people in the industry who you kind of align with and get a bit of a feeling and a vibe to see how you go. And then I would always say definitely work with someone, particularly if it's your first property, just because I've just seen so many people make mistakes in the industry. And if you can avoid a mistake, if you can avoid a 100 grand mistake with a 10 grand fee or a 20 grand fee, like it's a much better outcome for you long-term, big picture. Unless, and I'll give this a caveat, you are just all in on property, you've done all your research, you know the areas that you're buying in, you know it like the back of your hand, you've been reading and researching everything. If you feel like you're that type of person, then by all means, you will have the confidence to go out and know what you're buying and know what you're doing. But yeah, if you're a little unsure or you're listening to all these things, just find 1 or 2 people you resonate with, have a chat to everyone, get to know them properly, and then do one, see how you go, and then you can continue to build the portfolio from there.
Love that. And I'm pretty sure people are resonating with you and that advice right now, Jordan. So thanks very much for coming back on the show and sharing all of that gold today.
Thanks for having me, Mike. It's always a pleasure.
Cheers.